Hello, everyone. Today, Henry Tiberi and I are coming to you. I'm in South Carolina. Henry is in Colorado. Henry, do you want to say hello?
Hello.
You'll have to forgive him. He's got a little bit of a cold, so he'll sound a little scratchy voiced. But today, we're going to tag team potential speed bumps in the transaction process. I'm just talking about some different facets of that. But before we get started, a few housekeeping items, and then we'll go over just some general information. Then we'll dive into today's topic. As far as any questions, feel free to use the chat feature of Zoom. Marissa on our team will be monitoring those and getting those over to us, and we will answer those throughout the session. So feel free to ask them at any time. So let's get started. So if you're new to Hinge, maybe you don't know all that we offer, or if you already know, it's just a good reminder. The main thing we do are selling services for childcare owners. We offer a variety of resources when you are preparing to sell your school or schools, or looking towards or could be just right away. I mean, typically you want to have plenty of preparation time, but these are some items that we provide. We will provide a business evaluation. We have dedicated in-house financial analysts who have a wealth of knowledge and experience. So they are very good at looking at your numbers, working with you with that information, and working with our transaction advisors to come up with a very good business valuation. Buyer sourcing, we really are proud of the relationships we have with over 500 active buyers. We would not include anyone on that list who we don't feel, is obviously with strong financial background or other like culture, resources, etc. Transaction management. This is the point that Henry and I really love. We have closed over 300 successful transactions. We believe that we're I'm just going to say, I feel like we're good at this. We believe in the process. We believe that having an advisor in the process is very important. Can you do this on your own? You could go direct, but do you want to do that? That is a much harder process and oftentimes leaves a lot of value on the table. Going through a process will let you see what the range of offers can be from various buyers. And it also gives you an opportunity to find really the best fit. You don't want to always just focus on the right value. You want to find the right culture fit, team fit. Obviously, you care about your staff and your children. So sometimes the buyer's culture and their processes will speak to you more, as well as the actual process of diligence and getting through it. Some buyers have a longer time frame, while others have a shorter process, so that could also play into your decision. But your transaction advisor that's definitely part of the process. They will talk you through. Shift Childcare Leaders Conference. We have picked the date and we picked the location, which we're very excited about. Santa Barbara, California at the Ritz-Carlton Bacara. It's November 4th through the 7th, so that you can have time on the front end or on the back end on the weekends to spend a little extra time in California. Registration for that will open most likely in August. And if you've tried to attend in the past and were able to get in, you know that it sells out quickly. So just sign up. On our website, you can actually sign up from our website or from shiftchildcareleaders.com, where you can be on the mailing list for news on Shift and when the registration dates open up. And then, of course, as things build out, speakers and so forth.
Carrie, the registration will not open until about sometime around August.
Yes. I mean, that's what we expect, August of 2024.
And I'm going to note that November 4th to the 7th is a Monday, Tuesday, Wednesday.
So, I think Thursday, right? We usually end at.
You're correct. It's on Thursday. It ends on Thursday.
So Monday through Thursday, we usually end at noon on that last day. And the first day is usually a kickoff, like cocktail party. So then 2 full days of the conference and then a half day. All right, so leadership sprints. Tom Wood on our team, we came to know Tom because we as a team did our own leadership sprint, I believe 2 years ago. These are typically 30 minutes and he times them. With your team, you can sign up for a leadership sprint and you can help design the course topics. Typically there's, I believe, 8, but he can tailor it as needed. And actually our team is going to do another sprint in January just because we've missed it. Tom not only focuses for your team on excellence in the workplace, but also excellence in the home. So it's a really great opportunity. And something new, some people don't have a big team where they can do a sprint. So Tom is offering solo sprints where you can join other individual like childcare owners to do these leadership sprints to focus on different leadership, different topics that Tom will offer. And mastermind groups. Alita Mechtel from our team she is really great with her mastermind groups. She pairs groups together for like-minded size schools or number of schools if they're owners. And she has opened up some additional spots for that. So feel free to go to our website to get information on those mastermind groups. And then also, so this really plays into what we're talking about today for one of the road bumps you come across. When you're preparing to sell, you want to be in the right place financially. And in order to do that, a great place to start would be financial coaching with Zach or Christine or Stephanie. They work with us to do financial coaching for clients who want to know more about their QuickBooks, learn about cleaning them up, making them just run more smoothly so that they are very prepared for a process, but also just running your business. So they do a great job. And then last but not least, follow us on social media, Facebook and Instagram. You can look for those for our webinars, conferences, and just other things in the news that we put out there. I'm going to turn it over to Henry for just a minute just to introduce today's agenda.
Okay. Thank you, Carrie. Today's agenda is potential speed bumps in the transition process. And Carrie and I thought about it. When you go to sell your business and work with Hinge, you're taking a road trip with us. And you want to pick the people on your road trip wisely to help you get down the road. We've got a few different topics here. Accessibility to information, which Carrie will talk about. Carrie collects all the information that the buyer asks for, and it's substantial. I'll talk about advisors. I'll give an overview on deal structure, some tax considerations, so stay awake for that. Licensing, and then we'll talk about something that every seller gets concerned about and wants to know about, and that's when do you announce to your staff that you're selling your business?
Okay. Accessibility to information. So this can definitely be a roadblock in that sometimes our sellers are a one-person shop where they are the director, they're the owner, they are the accountant, they're everything. So before you are ready to sell, you want to make sure that you have accessibility to information, whether you're a one-person shop or whether you have a huge team of people, because oftentimes owners wait to tell their team or certain people on their team. So there is going to be information you will need access to ahead of time, whether it's for the valuation, for the marketing piece that Marissa helps put together that really beautifully outlines your school and showcases it. And then most importantly, for diligence. So the diligence process, like Henry said, when you do a process, you will have a transaction advisor who will quarterback that entire process. And then I'm the transaction manager so that I help with the diligence phase all the way to close. And I am there to help you, like Henry said, to collect information, sort through it, I review it, organize it, get it to the buyer, and work through any questions you have. It is a long process, but it's one that is doable, especially if you are prepared. So having access to information, financials, if you have an outside bookkeeper where you don't touch your financials or you don't even know how to access QuickBooks, either you want to gain access ahead of time or you want to be able to have access to prepared monthly financials. Whether you have one school or multiple schools, you want to be able to show a monthly profit and loss statement. If you have multiple schools, you really want to run financials for each school separately. Having one consolidated financial is extremely difficult for a buyer to get a feel for how each school is running and to see their expenses and their revenue and so forth. That's something that you can work out ahead of time. So definitely that's something to keep in mind. Historical financials, for taxes, it's going to be a 3 to 5 year look back. So you'll want to have access to your tax returns. For your profit and loss statements and then balance sheets, typically it's going to go back to 2019 at this point, sometimes further. And yes, they still look at 2020, even though we know that is not a good showcase of your school. It's just part of the process. Enrollment. So some people use, oh, go ahead, Henry.
I'm going to jump in on financial records. Many of our owners run personal expenses through the business. And we, when we represent you, we call them add backs to determine what your cash flow is. And it's very important that you come up with documentation to support those. And quite often that's going to be credit card statements and insurance bills for car insurance, because you're allowed to run your car through the business, but the buyer's not going to use that car, so we get to add that back, but we have to substantiate those. And that can be quite onerous. So just be aware, and it's probably not a bad idea to now start downloading credit card statements and keep track of what's personal. Well, what we call personal, we also call discretionary, which is a better word for it. Things that you don't really need to spend on the business that quite often benefit yourself. So
that's a very good point, Henry. Thanks for bringing that up. And before I get started again, one that just reminded me, one important thing that we don't want to be a roadblock is don't be embarrassed about your financials. We hear that where people are like, I don't know if I can come to you because, they're not in order. I've been running a lot of, like Henry said, owner expenses through those. Listen, you run your schools how you run your schools. Second point is we will make it through this process one way or another. So although we're giving you all this information to prepare, know that we have worked with clients who do pen and paper, who do just Excel, who have, all the systems in place. So we will make it work. But we also don't want you to be embarrassed about the state of your financials. We will work through that. So never let that be a roadblock to beginning a process. Going back to just having access again to enrollment. This is something recently where I've seen some people don't keep historical enrollment numbers on hand. They feel like once they've gotten past it, they've gotten past it. So if you're not tracking enrollment by month, by class or program, I would start now. Just use as simple as, even if it's on paper or using a simple Excel spreadsheet, tracking it by classroom, and that pertains to by school as well if you have multiple schools. So if you're not using a system like ProCare or any other Kangaroo Time, other systems that will track it, Brightwheel, you can just do it on pen and paper or in Excel. And buyers typically do want to see basically a 3-year look back on enrollment if you have it. Again, sometimes you just don't have it, but something to keep in mind. Operational, you just need to have access to, which I'm sure you probably would, employee and staff handbooks, insurance policies. Any buyer, it will look at your current insurance policies to be sure not that they either get the same coverage, if not more coverage in place. Be able to access any systems that you have in place, whether it's related to, like we talked about, enrollment or for staff. I mean, there's different systems in place that track different things. As far as staff, we really have to build out a staff roster. So if you can start one now, let's say your payroll system doesn't generate this for you, or you're not using ProCare where you're keeping the employee data in there. Again, it's as simple as an Excel spreadsheet. Just keep a list, staff names, dates of hire, dates of birth, or addresses. I'm sure you've got that. And then you can add to it where if you have any employee benefits, you're tracking who's enrolled, if they're receiving any special discounts on tuition or any other. Sometimes owners will provide tuition assistance for employees to go back to school. Any staff credentials. I was about to say accreditation, but staff credentials, whether they have associates or bachelor's degrees, master's degrees, anything of that nature. So I am more than happy if you want to reach out ahead of time. Oh, Henry, yes.
Well, I was going to say, I think you're going to say what I was going to say, which is we are happy to give you an example of a template to maintain a staff roster if you like.
Exactly. So what I was going to say is feel free to reach out at any time if you want to figure out things, easy ways to start tracking different parts of your school business. And then also if you just need help talking through any of these. So that's a very high level overview just on one part of diligence. I'm going to turn it over to Henry now to talk about the real fun parts with tax and legal and so forth.
Carrie, you're going to push the slides forward. Thank you. So now you know what you need to have for data and materials. I was going to give you some tips on CPAs and attorneys, and choose wisely. Your CPA will help provide financial details. Many of our clients prepare their own financial statements in QuickBooks, hand them over to the CPA. The CPA makes adjustments for depreciation and corrections. And we're going to need to be working with the CPA to reconcile what it is that you gave us in QuickBooks to what ends up on your tax return. When it comes to attorneys, my caution is that pick an attorney that has a focus on small business transactions. Quite often somebody will get a recommendation and the person's a litigator, and they'll do divorces, they'll do DUIs, and then they try to tell us that they can sell a business. There's really nothing worse for you than when you need your attorney to help negotiate through a contract provision or to schedule closing, and they're in court. So if your attorney spends any time in court, they're not a business transaction attorney. And there's also plenty of attorneys out there that I call M&A wannabes, because M&A sounds really sexy. They want to try their hand at selling a business, and let's not let them get practice on your deal. People often want to use their attorney that has done their will, helped them buy their house, and maybe help them through some other matters, and you might have a high level of trust in your attorney, and that's great. At a case-by-case basis, I try to help people figure out if that attorney is their best choice, because I do respect that. We respect that people have a lot of trust in their family attorney, but they may not be the best choice for helping you sell the business. And sometimes they are, though. So sometimes that does work out. Carrie, do you want to move to the next slide? The deal structure. I need to move. Okay. Okay, thank you. So feel free to chat questions to us. We typically, what we see are either a stock deal or an asset deal. And you should ask yourself why care and what's the difference? I've been doing this since the mid-90s, and back in the 90s, nobody would do a stock sale because of the liability that comes along with the business when you buy the business. So when you're buying the stock of the business, you're buying the shell of the business and everything in it, including the books, and you're picking up everything at the seller's basis on their books. An asset sale, you're buying the goodwill of the company, the name, all the records, all the furniture, fixtures, and equipment, but you're not buying the shell of the company. Typically, when a buyer does that, they either add your business assets to their shell, or they create a separate new company. Lately, we've seen more and more people agree to a stock purchase. The reason that they'll agree to a stock purchase is in some states, you can buy the stock of a childcare business. And since you're not changing the name or the employer identification number because you're buying the shell, you don't have to get a new license. And that can make things go much more smoothly. Your CPA will tell you, do a stock sale, because in a stock sale, all of your profit is treated as capital gains. Just be aware that almost always, in fact, I don't recall seeing a deal without this. If a buyer buys your business, they buy the stock of your business, they're going to require what's called a Section 338H10 election. And under that IRS tax election, your stock purchase will be treated as if it was an asset purchase. So for tax purposes, under an asset deal, what you don't like about that as a seller is that you have something that can be kind of nasty called recapture tax. And that is, to the extent that your sale price exceeds what you paid for your furniture, fixtures, and equipment, the depreciation is taxed at ordinary income tax rates instead of capital gains as goodwill or a stock sale would be treated. So I don't see any questions on it on that. So I'll just keep moving unless if you have a chat question, please send it in. Something else that we've seen is a type F reorg. And that is, if you're selling an S corporation, the buyer may say, we'll do a stock sale. But if their entity, their business entity, is not allowed to own an S corporation, and there is a rule that most corporations that will be requiring you cannot buy an S corporation, they have to convert to an LLC. So this will also require a new child care license, because you're going to end up with a new employee identification number. Next slide. So tax considerations, I touched on this a moment ago. Under an asset purchase agreement, you'll be required to do a purchase price allocation. And there's actually a form that both buyer and seller need to complete. It's Form 8594. And whatever the seller puts on is the purchase price allocation the buyer has to put on. And what we usually get hung up around is how much money goes to furniture, fixtures, and equipment. And that's what triggers, those are depreciable assets. You as the seller have depreciated those assets. And the more money that's allocated to furniture, fixtures, and equipment, the more recapture tax you'll have at ordinary income tax rates. And as a seller, what your objective is obviously to minimize taxes. So what we want to do to minimize taxes is allocate as much as possible to capital gains. So generally speaking, the price of the business will be allocated to furniture, fixtures, and equipment, with the balance being allocated to goodwill. And goodwill is treated as capital gains. For the buyer, the reason they want to allocate more to the furniture, fixtures, and equipment is because they get to depreciate that over 5 years, and anything that's allocated to goodwill, they have to amortize over 15 years. So it's really a timing difference for the buyer, but it's a real tax dollar difference for the seller. And when we're negotiating letters of intent or contracts, we work pretty hard to get a favorable purchase price allocation for you. Another thing you'll hear about is a 1031 exchange. If you're selling your real estate, if you want to just completely get out of the business and the real estate, you don't want to be a landlord to the buyer, you're going to have to do something with that money when you sell the money that you got for the real estate, and you don't want to pay taxes. So there's something called a 1031 exchange, or Starker exchange, or like-kind exchange. They're all the same thing. Many people are familiar with these now. You have 45 days to identify a replacement property, plus another 145 days to close. So just some food for thought if you're selling the real estate. You can go and buy an apartment building. You can buy a Starbucks, which is a really high credit tenant. You can buy an office building, a variety of things. And I mentioned earlier, the Section 338 H10 election is the election that a buyer is going to require to treat a stock sale as an asset purchase agreement. So somebody has asked me, what's a way to soften the tax hit when selling? Just looking at my questions here. One would be a 1031 exchange if you're on the real estate. What you can also do if you're selling business in real estate, we may be able to, let's say the business in real estate, a child care center, and the business is combined $5 million. What we may be able to get the buyer to do is agree that it's, well, let's say it's combined $5 million, 3 million for the real estate, 2 million for the business. What we might be able to do is get the buyer to agree to pay more on the real estate and less for the business. And if you do a 1031 on the real estate, you'll get the taxes never go away. They're deferred, which is another topic, but they're deferred, but you could defer more taxes that way. The other way to soften the tax hit is the purchase price allocation. To minimize the recapture tax, and we're actually quite successful doing that. You'll hear me, or you'll hear me say this, or you'll see this in the letter of intent. I want the buyer to agree that the amount allocated to furniture, fixtures, and equipment is the seller's tax net book value, and we can get into that if somebody wants to know what that means. But that's typically how we'll do it. So, okay, next slide, please. Okay, licensing before or after closing. And by the way, I'm wondering if anybody recognizes who that is. If you do, please chat. You got to be I guess, of my generation. So the licensing. It used to be that everybody wanted to close before, everybody wanted to obtain a license before closing. And nowadays, some of the buyers will agree to obtain licensing after closing. And the reason the buyers typically want to do it before closing, okay, we got a right answer. It's Jackie Gleason and Smokey and the Bandit. So I'm sorry, I lost my train of thought. So the reason why we want to license before closing is they want to be sure that there's nothing that's going to come out from the licensing rep that's going to cost the buyer or the seller money to obtain the license. And in my days when I was acquiring centers, I was with American Children's World, and we were always concerned that the licensing rep was more lenient on the seller, who's typically a mom and pop, who had a nice personal relationship, and we were a larger corporation with 600 centers. The licensing rep would decide if at that point, well, we've grandfathered certain provisions, but now it's time to bring them up to code. And what the buyer doesn't want to do is learn that afterward. Typically, there'll be a provision that if there are deficiencies, that the seller is going to pay them. And as a seller, what you don't want is to close and then get a bill and have very little control over the cost to remedy what the issue is. And I've seen this with things like, when they went to 4-inch. When they changed the fence picket spacing to less than 4 inches, you get an old cedar fence that dries out, the wood shrinks, and it's 4¼ inches spacing. So someone's got to replace all the fence pickets. Seen it with playground equipment, fall zones. I've seen fall zones that I can't believe licensing approved. I once saw a fall zone, the fence was too close, so they put the fall zone vertically on the fence, and somehow they were licensed to do that. And if a significant operator comes in that has more resources, the licensing rep is typically going to ask that those things are brought up to current licensing regulations. The other reasons to announce before that buyers prefer before typically is if there is something that hasn't been disclosed that staff knows about. They've had the opportunity to talk to staff. I've never actually had any staff report something negative that we didn't already know, but it can occur. And they want to announce to staff prior to closing because they want to put all the staff, they want to find out who they're going to, like, they interview them, want to find out who they're going to keep, which generally, it's almost always everybody, but they also want to get them into the payroll, onboard them into the payroll system so that immediately after closing, when the payday comes, their paychecks aren't late, because nobody wants unhappy employees, particularly in this labor environment. When we see after closing, it's typically a stock purchase. We've seen some very aggressive buyers who are trying to meet growth deadlines, and they want to get the deal closed and get operating. And sometimes they'll even do if it's an asset purchase agreement, and they need a new license, they'll do so. They'll close the deal with a management agreement where you still own the license, but you have an agreement with them to manage it. Okay. I'm sorry, I'm reading the chat here. So a question came up about what happens if a licensing issue arises during the process. Well, first of all, we got to disclose it to the buyer, obviously, and it can slow a deal down. I'm working on a deal right now where we were motoring up to closing. We had it in our sights, and a child was left on a bus for 3 minutes. Unsupervised. The operator self-reported it, and the licensing reps 6 months later have not decided what official action they're going to take. And understandably, the buyer doesn't want to close on the deal until they have an answer on what action licensing will take and if it's going to somehow impact the buyer. So licensing issues can come up during that period. Other things that can slow a deal down is accreditation, particularly if your state has a rating system, and if there's an amount of subsidy involved in the deal. Quite often the subsidy rates are tied to your level of accreditation or rating. And what the buyer doesn't want to do is close and then be told they're taken from 5 stars down to 1 or 2 stars, and their funding is dropped, and it's going to take 60 or 90 days or longer to improve their star rating. So those are some considerations regarding licensing. So the announcement, when do you tell? And Carrie's welcome to jump in on this because we have very long discussions on each deal about when it's appropriate to announce. I prefer to announce. I think a good timing for announcing, if everything else falls into place, is about 3 weeks. You don't want to give your employees too much time to wonder what's happening. But you also don't want to let them know at the last minute. And the sellers typically push to minimize the time between announcing and closing. and buyers try to push this out. And I've seen it be 3-4 months and it go off without a hitch. I once had a seller put a sticky note on the door on a Friday that they sold the business and it's going to be new ownership on Monday, which was awful. So I don't recommend that. I think I gave you some reasons under licensing why it's a good idea to announce first. And Carrie, maybe you can talk a little bit about the process, because I'm running out of voice, and the letters and the meetings. Thank you.
So a couple of thoughts I had. As far as announcements, we find that if you're not the director, if you have a director in the school or schools, or a management team, of course, with your assistant director and so forth, we find that bringing them into the fold ahead of the regular staff announcements really helps. It could be just a couple of days before, it could be a day before. Going back to what I talked about several slides ago, if you need help in this process to gather information, it may be if you feel like you can really trust your director, or if you have a regional manager, an executive director, if you feel like you can trust them to keep this, confidential throughout the process, you can bring them into the fold to help you with the diligence process. Oftentimes sellers will do that and include a bonus tied to, obviously, when the transaction closes, changes ownership. So, but flash forward to the staff announcements. Even if you tell your director or your assistant director the day before your staff, it just helps. They need time to let that news sink in, because once you tell your staff, they'll hear the words and they'll immediately look at the director and assistant director to gauge their emotions on what's coming up. So if you have your management team feeling confident and comfortable with it, that really, really helps. As far as when you do the staff meeting, there will be members of the buyer team there on whenever you're ready for them to come in to answer questions, because your staff will most likely be very sad that you're leaving, but immediately their first thought goes to, what about my pay? What about my benefits? Am I going to have my job? So as much as they love you, that's where their brain is going to go, first of all. So having the buyer team there, oftentimes they'll have a packet ready to talk to the employees about their role, their salaries, and know that when someone wants to take over your school, they don't want to rock the boat. They want to keep the salaries as is, if not improve them, and then also potentially provide opportunities for your staff to grow with that other company or within the school. So, and then at the same time, typically our clients have an email queued up during that staff meeting to have sent out to parents, so that they're not receiving a text from a staff member who they're very close with or friends with. And in that email would be a letter from you as the seller. And we have examples from prior owners. We have several examples with varying tones of, how involved the owner was and what the transition is going to look like. And then you typically include a letter also from the buyer, so that they can become familiar with that company, with the school company that will be taking over. And then
Go ahead.
Well, one last thing, Henry.
Go ahead, Carrie.
Yeah, so following the staff announcement, and then the next day, typically that the buyer's team will be in the school, so that when parents show up, if they have questions, they could be answered by the buyer, by their team. And typically that buyer team, it may be someone from their more corporate office or head office, but a lot of times it's a regional director, maybe from another school they've acquired. And oftentimes people who you will deal with throughout the transaction process previously may have sold a school to that same company. So they've been through the process. They can appreciate the emotional side of it, so they can really help during that. Henry, did you want to add something?
So on the announcement too, I was going to add on timing. I mentioned 3 weeks, but another rule of thumb I have is when the buyer submits a licensing application, at that point your licensing rep in the licensing office knows something's going on. And I always suggest that if you don't completely trust them to keep it confidential, which I think is hard, that's a good time to announce, because the last thing you want to do as a seller is have your employees find out through the grapevine, and then come to you all upset. We did get a question regarding bringing the new owners into the center so that the staff can start building a relationship. Most buyers will want to do that. They'll bring in operations people and HR people. Sometimes they sit down individually with people, talk about their employment history, the benefit package that's being offered to them. Quite often, the employees are happy because they're getting offered some benefits that they weren't in the past, and they can start building a relationship. We try to referee that. We don't want you're the owner and you're in charge until we close. And we want to be careful that the employees aren't getting mixed signals from the buyer. So we keep an eye on that, and it's different in every case.
Henry, the only other thing I would add in is when you bring in the buyer, the new owners to the school, before they come into the school, when you're telling your management team or your director and assistant director, they will typically do an off-site meeting with them, let's say at a coffee shop, a hotel, somewhere not outside of the school, so that your management team or your director and assistant director can be away from the school and not have the distractions, and so they can really get to know the new owners before they then are helping the staff transition into being comfortable with it. And then Henry, did you see the other two questions above that?
I did. I can answer those questions. So somebody asked about lease agreements and what happens. So generally speaking, a lease agreement is going to have a provision addressing assignment of the lease. And it may state that the tenant, being you, can assign the lease to a new operator, and the landlord has the right to approve it, but their approval shall not be unreasonably withheld. Unreasonably withheld generally means that the person who's taking over your lease is as strong a credit tenant as you or better. And if a national or regional buyer is buying your business, that seems like a slam dunk. However, under your lease, you may have personally guaranteed it, and the operators of a multi-site, multi-state childcare business, it's pretty unusual for any of those guys to put their house up like you did. So it depends on your landlord. They may give you a hard time about it. So generally speaking, the leases are assignable under a stock deal. If someone's buying your company and your company is the tenant in the lease, there's really no assignment. It just stays with the company. There can be change of control provisions, because in substance, the owner really did change. This can be a real sticky wicket, assigning leases. Very often, Carrie can attest to this. We get stories from landlords about how wonderful the relationship is. I'm sorry, sellers tell us how wonderful the relationship is with their landlord, and it probably is. But the landlord's personality changes when they find out that a large national company is coming in. Sometimes they see it as an opportunity to change some provisions of the lease, including raising rent if they think you've been getting a good deal. The buyer may ask for a couple tweaks in the lease, and as soon as the buyer asks for some changes in the lease, it's not an assignment anymore, it's an amendment, and then the landlord feels entitled to start asking for things. So the answer is generally yes, the lease is assigned. And some of the things that I've seen buyers ask for is to take out I've seen a right of first refusal provision where the landlord had the right to buy the business. And obviously that can't stay if somebody else is buying the business. I've seen I've seen provisions in there where it was a church and the church had the right to approve the program. A national buyer is not going to allow that. So there's different things that come up in the lease that the buyer may object to. Well, the other thing I was going to mention was if there's, let's say there's 6 years left on the lease, that buyer wants 10 years. And if there's not an option to extend, it might be a wonderful lease, but they're not going to like it without that option to extend, and they're not going to close the deal. So then we have to go back to the landlord. So quite often, what sounds like it's going to be a simple lease assignment turns into an amendment of the lease. Somebody else asked, should I sign a new lease in advance of selling my business? I think that all depends on how good your current lease is and what the term is. Buyers are generally going to want 10 years. If they're paying a lot of money for your goodwill, they want to be able to enjoy the business that they're buying for 10 years, and they need a home. So they're going to ask for a 10-year lease. And if you can negotiate a new lease, and you're thinking of selling your business, obviously get the best terms you can on rent, which you're going to do anyway. Get a 5-year lease with 3 5-year options, or a 10-year lease with 2 5-year options. And work out assignment provisions that you can talk with your attorney about this, assignment provisions that make it go as quickly and easily as possible.
Henry, we had 2 other questions that we can tag team. Are you done on that with leases?
I am. I need to read those 2 questions.
Sure. I'll do the bottom part and give you a second to take a sip of water. So this is a good one. As an owner, I don't have much of a relationship with employees. Does that change how the announcement is made? That's a great question, and you're right. So not all owners are really involved with the school. Some are very emotionally tied to the staff, to the children, to the parents, but others are, operate maybe from a different state. They've built a team who runs the school, and we did recently have a transaction where really the director and the admin staff did the announcement. I believe the owners might have been on Zoom, but you do not have to be very tied to your school to do that. You can be a part of it, but it changes the tone of the letter. And those sample letters we have, they are a variety. There are some that are just more straightforward. There are others that are very heartfelt. So it can change how the announcement is made, but the buyer will work with you on that. And if you have multiple schools, we have in the past, if you can't have a meeting at every school, sometimes a Zoom meeting will be arranged so that everyone is hearing it at one time, or various locations. And then Henry, do you want to talk the first part?
Well, I was going to add to that. If you're anticipating selling your business, it's good to start positioning yourself so you don't have such a tight relationship with your employees. I'm sure you've heard it before. You want to, particularly if you're going to sell the business, you want to work yourself into a role where you're working on the business, not in the business. It's always a problem when the center owner is the center director and they're also the secret sauce. And buyers don't like that so much because, what happens when Miss Daisy, the owner and center director, leaves, and things aren't the same. It's greater risk that parents and staff are going to leave. The other question, and I think we're running up against about 10 minutes. So if people want to submit more questions, we're happy to answer them. Carrie and I could probably talk about war stories and bad things that happened during due diligence, and how we've dealt with them. If people have any specific questions about what can go wrong, right? So somebody asks, what is a typical reasonable amount of time for the buyer to expect to stay engaged or continue working after closing? Some buyers will ask for a consulting agreement. Usually the bigger the buyer, the less they ask for. But they'll ask for you to, what they really want you to do is pick up the phone. If there's an employee that says, I swear that, Miss Carrie told me I could take the whole month of December off. the buyer wants to be able to call the seller and say, did you really agree to this? Or a pipe breaks and water's gushing out and they need to know where the shutoff valve is. They want to be able to give you a call. What I often do when, so buyers typically ask for more than they need or ever use as far as seller involvement. And when they do ask, what I'll typically do is negotiate for a tapering. So I might say the first 2 weeks they'll be available 30 hours, and it can be by phone. If they can solve the problem by phone, they can be available by phone. They don't have to be in person. And then it might go from 30 hours the first couple of weeks to 10 or 20 for the next couple of weeks, and then tapers off. We'll also put in there that the seller's role post-closing, if they stay engaged, is strictly for transition issues. If they're down-staffed, they're not calling you to go work a classroom. So those are some things that we typically address in a post-closing consulting agreement. And just know too that you're typically not going to get paid for post-closing assistance with the transition, because if you're selling your business and you're being paid goodwill, transferring the goodwill to the buyer is expected, as it should be. So got a new message. Okay, I think we answered that one. Carrie, did we have another slide?
Just for questions. So, Henry, do you want to give a quick overview, or we can just bounce back on just an overview on kind of the roadblocks? If anybody has any other questions? All right, how about this?
Avoid them.
Avoid them, yeah.
What Carrie and I and the Hinge team do during the due diligence process, a lot of what we do is problem solving. Something will come up. My van's about to break down. I'm under contract. What do we do? Do I have to go out and buy a new van? Recently we had an employee who was a center director who was dishonest about performing a fire drill and documenting it. So how do we handle that? So a lot of these road bumps are unique to the deals. They're problem solving issues. Go ahead, Carrie.
Oh no, I was just going to say what we say is there's never enough hindsight to imagine all the hindsight you need to have in this process. That's why it's great to have the right team, starting with a transaction advisor to your attorney to your CPA. You need to have the right team so that, number one, you're not in a process forever, that you can actually get through a process, and that you're getting through a process as successfully financial as you can, and that it's just you're already working a full-time job, so you need help during these processes. So aligning with the right people is your first step.
Yeah, and we'll anticipate things like, for example, if someone's buying the business in real estate, they're going to hire a surveyor's got to go out, an appraiser, and a phase one, and these are danger points. And what we'll do is we'll tell the buyer, tell your appraiser, it's confidential, make sure they know that. And then we'll ask, we'll ask for the appraiser's contact information so we can communicate directly. So what we never want to have happen is somewhere along the line, the communication not get through, that it's confidential. An appraiser shows up and says, hey, knocks on the door and tells the center director, I'm here to appraise the property for the sale of the business and building. So our job is to anticipate things like that. Besides just getting you through the process, it's to anticipate the problems and make sure that we get through those.
Well, Henry, I think we can give everyone a few minutes back of their day. And if you have additional questions, you can reach out to us on on our website, there's where you can submit questions, and we'll have a transaction advisor get back to you. But thank you, everyone.
Yep. Thank you. Feel free to reach out.